Welcome to Life Insurance Exam Prep. This is part 2 of 4 in our complete life insurance exam masterclass. Now that we've covered how life insurance policies are underwritten and issued, it's time to focus on what happens after the insured passes away, specifically who receives the death benefit and how it is paid out. This chapter is all about beneficiaries and settlement options too. Critical components of every life insurance policy. Understanding these concepts is essential not just for passing the exam but for ensuring that clients' policies fulfill their intended purpose, providing financial security to their loved ones. Let's start with the beneficiary, which is the person or entity designated to receive the life insurance payout when the insured dies. The policy owner, the person who controls the policy, chooses one or more beneficiaries, and this designation determines who gets the money. Beneficiaries can be classified in a few different ways, so it's important to understand the distinctions. First, there are primary and contingent beneficiaries. The primary beneficiary is the first in line to receive the death benefit. If the primary beneficiary is alive when the insured passes away, they receive the full payout. However, if the primary beneficiary has already passed away, the benefit goes to the contingent beneficiary, also known as the secondary beneficiary. This ensures that if the primary beneficiary preds the insured, the money doesn't go into the insured's estate, which could lead to delays and probate issues. Beneficiaries can also be revocable or irrevocable. Revocable beneficiary can be changed at any time by the policy owner without needing permission. This offers flexibility in case the policy owner wants to adjust their plans due to life changes such as marriage, divorce, or the birth of a child. On the other hand, an irrevocable beneficiary cannot be changed without their consent. Once someone is named an irrevocable beneficiary, they have the legally protected interest in the policy, meaning the policy owner cannot remove them or make changes that would affect their share of the benefit without their approval. This is often used in legal agreements such as divorce settlements or business partnerships. Another important concept is per capita versus per status distribution. These terms come into play when there are multiple beneficiaries and one of them passes away before the insured. With a per capita designation, the death benefit is divided equally among the surviving beneficiaries. For example, if a father names his 3 children as beneficiaries and one of them passes away before he does, the remaining 2 children would each receive half of the benefit instead of the deceased child's share passing to their own heirs. With a P-STARS designation, however, the deceased beneficiary's share would go to their own children. Using the same example, if one of the father's children had passed away but had 2 children of their own, those 2 grandchildren would receive their parents' share of the payout instead of the surviving siblings getting a larger portion. This method is that the insured's lineage continues to benefit from the policy. Now let's talk about estate and trust beneficiaries. While most people name individual beneficiaries, some policy owners designate their estate as the beneficiary. This means that when the insured dies, the death benefit is paid to their estate and distributed according to their will. However, this is generally not recommended because it can cause delays in probate, expose the funds to estate taxes, and make them available to creditors. A better option for those who want structured control over the death benefit is to name a trust as the beneficiary. A trust is a legal arrangement that holds assets for designated beneficiaries and is managed by a trustee. This can be useful for parents who want to ensure their minor children receive the money in a controlled way, or for wealthy individuals looking to minimize estate taxes. For example, if a policy owner sets up a trust for their children, the trustee can distribute the money gradually instead of giving them a lump sum all at once. Now that we've covered who can receive the death benefit, let's talk about settlement options, which determine how the payout is distributed to the beneficiary. While most people assume that life insurance is always paid as a lump sum, policy owners and beneficiaries have other options. The lump sum option is the most common because it provides the full death benefit immediately tax-free. This allows beneficiaries to pay off debts, cover funeral expenses, or invest the money as they see fit. However, some beneficiaries, especially those who are not financially experienced, may prefer a structured payout instead. One alternative is the interest-only option. With this settlement option, the insurer holds on to the death benefit and pays the beneficiary only the interest that accrues on the funds. The principal amount remains untouched and the beneficiary can choose to withdraw it at a later time. This is useful for individuals who don't need the full amount right away but want to earn steady interest income. Another option is the fixed period settlement, where the insurer distributes payments over a set period such as 1, 0, 20 or 30 years. The beneficiary receives equal payments during this time, and if they pass away before the full amount is distributed, the Remaining funds go to contingent beneficiary. This can help prevent the beneficiary from spending the money too quickly while ensuring financial stability over time. A similar option is the fixed amount settlement, where the beneficiary chooses a specific dollar amount to receive each month or year until the benefit is exhausted. This allows for more flexibility in budgeting but doesn't guarantee how long the payments will last, since it depends on the total benefit and the amount withdrawn. For those who want lifetime security, there's the life income option, which works like an annuity. The insurer calculates payments based on the beneficiary's age and guarantees payments for as long as they live. This prevents the risk of outliving the benefit, but it also means that if the beneficiary dies early, any remaining balance may be forfeited to the insurance company. To address this concern, there are life income with period certain options which ensure payments for a minimum number of years even if the beneficiary dies early. Understanding beneficiary designations and settlement options is crucial for passing the life insurance exam. These choices affect how the death benefit is distributed and how efficiently it serves the insured's intentions. Now that we've covered this key topic, in the next chapter we'll dive into policy loans, cash value accumulation, and non-forfeiture options, important features that come with many permanent life insurance policies. Now that we've covered how beneficiaries receive life insurance proceeds, it's time to dive into a crucial feature of permanent life insurance policies: cash value. This chapter focuses on policy loans, cash value accumulation, and non-forfeiture options, all of which play an essential role in how whole life, universal life, and variable life insurance policies function. Understanding these concepts is critical because they differentiate permanent policies from term insurance and impact how policyholders can access funds before death. Let's start with cash value, which is a living benefit that builds over time in permanent life insurance policies. Unlike term life insurance, which only provides a death benefit, permanent life policies have a savings component that accumulates tax-deferred growth. A portion of each premium payment goes toward maintaining the death benefit, while the rest is invested by the insurance company to build cash value. This cash value can be accessed by the policy owner in several ways, making permanent life insurance more than just a financial safety net for beneficiaries. The key ways to access this value are policy loans, withdrawals, and surrendering the policy. A policy loan is one of the most common methods policyholders use to access their cash value. Unlike a traditional bank loan, a policy loan does not require credit approval because the insurance company is essentially lending the policyholder their own money using the cash value as collateral. This makes it a quick and easy source of funds, often used for emergencies, business investments, or even supplementing retirement income. However, policy loans come with some important rules and risks. First, the loan ACRS interest, which the policyholder must pay back to avoid reducing the policy's value. If the loan is not repaid, the insurance company deducts the outstanding balance from the death benefit when the insured passes away. This means that if a policyholder borrows a significant amount and doesn't repay it, their beneficiaries might receive far less than expected. For example, imagine a policyholder with a $500,000 whole life policy and $100,000 in cash value. If they take out a $50,000 loan and don't repay it, the insurance company will deduct that amount plus any accumulated interest before paying the beneficiaries. If the total owed reaches the full cash value amount, the policy could lapse entirely. Policy owners also have the option to make withdrawals from the cash value, like a loan which must be repaid with interest. A withdrawal permanently reduces the death benefit. Withdrawals are typically only allowed up to the total amount of premiums paid, known as the cost basis, without triggering taxes. If a policyholder withdraws more than the cost basis, any excess amount is considered taxable income. For instance, if someone has paid $50,000 in premiums into their policy and their cash value has grown to $80,000, they can withdraw up to $50,000 tax-free. However, if they withdraw the full $80,000, the extra $330,000 is subject to income tax. Another way a policyholder can access cash value is by surrendering the policy. This means they voluntarily cancel the policy and receive the accumulated cash value minus any surrender charges. This is often a last resort, since surrendering a policy means forfeiting the death benefit entirely. Speaking of surrendering a policy, this brings us to non-forfeiture options, which protect policyholders from losing all of their benefits if they stop paying premiums on a permanent life policy. These options allow policyholders to retain some form of coverage instead of letting the policy lapse completely. There are three main non-forfeiture options, and standing them is essential for the life insurance exam. The first option is the cash surrender value. This allows the policyholder to surrender their policy in exchange for the accumulated cash value. However, there may be surrender charges, which are fees the insurer deducts for early termination, especially in the first few years of the policy. The longer a policy has been in force, the lower these charges typically become. The second option is reduced paid-up insurance. With this option, the policyholder stops making premium payments, but instead of canceling the policy, the insurer uses the existing cash value to purchase a smaller, fully paid-up policy. The new policy will have a lower death benefit but will stay in force for the insured's lifetime without requiring additional premiums. For example, if a policyholder has a $250,000 whole life policy but can no longer afford the premiums, the insurer may convert the policy into a paid-up policy with a reduced death benefit of $100,000. The insured will still have lifetime coverage but at a lower benefit amount. The third option is extended term insurance, which allows the policyholder to use their cash value to buy term insurance. Instead, this keeps the original death benefit intact but only for a limited period. Once the term period expires, the policy terminates unless the policyholder renews or converts it. For example, if someone has a $500,000 whole life policy but can no longer afford the premiums, they could use their cash value to buy a term policy with the same $500,000 death benefit. However, this new term coverage might only last 10 or 15 years depending on the amount of cash value available. Non-forfeiture options are important because they give policyholders flexibility when financial circumstances change. Instead of losing all the money they've put into their policy, these options allow them to retain some level of benefit. Understanding how policy loans, cash value, and non-forfeiture options work is essential because they impact how permanent life insurance functions as both a protection tool and a financial asset. These features allow policy owners to borrow against their policy excess funds in retirement and adjust coverage based on changing financial needs. In the next chapter, we'll explore another critical topic: riders and policy provisions, which provide additional benefits and customization options to life insurance policies. These features can enhance coverage, offer protection against disability or critical illness, and even allow for premium waivers under specific conditions. Now that we've covered life insurance policies, let's shift gears and discuss another key financial tool: annuities. Annuities are often used as part of retirement planning, and understanding how they work is crucial not only for the life insurance exam but also for advising clients on their long-term financial security. To start, let's break down what an annuity is. An annuity is a financial product that provides a steady stream of income, typically used to supplement retirement savings. The basic idea is simple: you make a lump sum payment or series of payments to an insurance company, and in return the insurance company guarantees regular pays back to you for a certain period of time or even for the rest of your life. Annuities come in various forms, but we'll focus on the most common types: fixed, variable, and indexed annuities. Each has its own features and benefits, so it's important to understand how they differ. First, let's talk about fixed annuities. A fixed annuity provides predictable guaranteed payments over time. The insurance company invests the money you pay into the annuity and in turn provides you with a fixed rate of return, meaning you know exactly how much you'll receive each month. For example, if you invest $100,000 in a fixed annuity with a guaranteed 4% annual return, you'll know that your annuity will pay out a fixed amount based on that rate. Fixed annuities are typically less risky because they offer stability and security, which is why many people use them as a predictable income source during retirement. Next, we have variable annuities. With a variable annuity, your payments fluctuate based on the performance of the underlying investments, such as stocks or bonds. The key difference here is that while there's the potential for higher returns, there's also more risk involved. If the market performs well, you could see larger payouts, but if the market drops, your payouts could decrease. For instance, if you invest in a variable annuity and the investments perform well, your monthly payments could be much higher than in a fixed annuity. However, if the market crashes, your payments could be lower or even less than your initial investment. This makes variable annuities a better fit for people who are willing to take on more risk in exchange for the possibility of greater returns. Then there's the indexed annuity, which combines elements of both fixed and variable annuities. An indexed indexed annuities returns are tied to the performance of a specific market index like the S&P 500, while the returns are typically not as high as those of a variable annuity. Indexed annuities offer a balance between risk and reward. If the market performs well, you'll receive higher payouts, but if the market doesn't do it as well, your payments won't drop below a minimum guaranteed amount. This means you have some upside potential, but also a safety net if the market underperforms. Now that we understand the main types of annuities, let's talk about the two key phases of an annuity: the accumulation phase and the payout phase. During the accumulation phase, you're making payments into the annuity either as a lump sum or through periodic contribution. This is the period where your funds grow either through a fixed interest rate, variable investments, or an index. The longer you contribute to the annuity, the more it will grow and the larger your eventual payout will be. Once you reach the payout phase, the insurance company begins making regular payments to you. These payments can last for a specific period, like 10 or 20 years, or for the rest of your life, depending on the terms of your contract. The payout phase is what most people are focused on when they invest in an annuity, as it provides a guaranteed stream of income during retirement. An important consideration with annuities is taxation. The money you invest in an annuity grows tax deferred, meaning you don't pay taxes on the earnings until you begin receiving payments. However, when you do start getting paid, your annuity payments are subject to income tax. This is an important factor to keep in mind when planning your retirement, as it impacts the amount you'll actually receive after taxes. One more thing to note is annuity suitability. While annuities can be an excellent tool for some people, they are not right for everyone. They can be more expensive than other retirement savings options, and in some cases the terms may be restrictive. Therefore, it's essential for agents to assess the needs and financial goals of their clients before recommending an annuity. For example, if someone is young and looking for growth potential, they may want to consider more aggressive investment options. On the other hand, if someone is nearing retirement and looking for guaranteed income, an annuity might be a perfect fit. Finally, we can't talk about annuities without addressing senior protections, because annuities are commonly marketed to retirees. Many states have specific regulations to protect seniors from misleading sales tactics or unsuitable product recommendations. These regulations include ensuring that agents fully disclose the terms and risks of annuities and evaluate whether the product is appropriate for the client's financial situation. Understanding annuities and their role in retirement planning is crucial, because for many clients these products can provide a reliable income stream in their later years. Annuities are a unique tool in the financial landscape, and knowing the ins and outs of how they work will help you better serve your clients and help them make informed decisions about their future. In the next chapter, we'll explore federal and state regulations that govern life insurance products and agents. These regulations help ensure that both consumers and agents are protected, and understanding them is essential for passing your exam and succeeding in the field. In the world of insurance, it's not just about the policies themselves. There are also a variety of federal and state regulations that shape how the industry operates. As an insurance professional, understanding these regulations is essential not only for ensuring compliance but also for providing the best service to your clients. This chapter will dive into the role of state insurance departments, the National Association of Insurance Commissioners, North Carolina licensing requirements and fair trade practices, and much more. Let's start with the role of state insurance departments. Each state in the US has its own insurance department that is responsible for regulating the insurance industry within that state. These departments oversee the licensing of insurance agents, monitor the financial stability of insurance companies, and enforce rules designed to protect consumers. For example, if a consumer has a complaint against an insurance company or agent, they can contact the state's insurance department, which can investigate and take action if necessary. The state insurance department ensures that both consumers and agents follow the rules, and they provide oversight to make sure everything is fair and transparent. At the national level, we have the National Association of Insurance Commissioners, NIC. The NIC is a collective organization made up of state insurance regulators. It works to promote uniformity and cooperation among the states to regulate insurance in a way that protects consumers while allowing the industry to thrive. The NIC drafts modeled laws, which are guidelines that states can adopt to standardize insurance regulations across the country. While each state has the authority to make its own laws, many states choose to follow these modeled laws to ensure consistency. For example, the NAICS Model and Fair Trade Practices Act provides guidelines to Prevent insurance fraud, misrepresentation, and other deceptive practices. While individual states can tweak these regulations, many of them base their laws on AIC's model standards to create a unified framework for the industry. Next, let's talk about licensing requirements. In order to sell insurance, agents must be licensed in the state where they plan to do business. Licensing requirements can vary by state, but generally an agent must complete pre-licensing education, pass a state exam, and submit an application to the state's insurance department. Each state sets its own exam content, so agents must be familiar with the specific rules and regulations in the state they are licensed in. For example, if an agent is licensed in Illinois, they are required to understand Illinois specific insurance laws and regulations. If they want to expand their business to another state, they will need to meet that state's licensing requirements. This may include taking an additional exam or completing continuing education courses. Once licensed, insurance agents also have ongoing responsibilities. Continuing education is required to keep a license active. States typically require agents to complete a certain number of hours of education every few years. These courses ensure that agents stay up to date on changes in laws, regulations, and best practices. Continuing education is a critical part of an agent's career because it ensures they remain knowledgeable and compliant with the law. Now let's move on to unfair trade practices. Insurance companies and agents must operate ethically and fairly, which is why there are strict rules in place to prevent unfair trade practices. These include misrepresentation, caution, rebating, and false advertising. Misrepresentation refers to giving false or misleading information to a client. For example, if an agent tells a client that a particular policy offers benefits that it doesn't, that would be considered misrepresentation. Similarly, caution is when an agent pressures a client into buying insurance which violates ethical standards. Rebating is the illegal practice of offering a portion of the premium or commission to the insured as an incentive for buying a policy. If an agent offers money or gifts to a client as a way to influence their decision, that's a violation of unfair trade practices. Another major area of regulation is advertising and sales practices. The insurance industry is tightly regulated to ensure that advertisements and sales materials are truthful and not misleading. For example, if an insurer promotes a policy as having certain benefits, those benefits must be clearly stated and substantiated. Misleading advertisements can result in serious penalties, including the loss of an agent's license. Now let's talk about privacy laws and consumer protection. Insurance agents handle sensitive personal and financial information, so it's important to understand privacy regulations. The Graham-Leach-Bliley Act (GLBA) is a key federal law that protects consumer privacy in the financial services industry, including insurance. The GLBA requires insurance companies and agents to safeguard customers' personal and financial data. They must also give consumers the opportunity to opt out of having their information shared with non-affiliated third parties. Similarly, the Health Insurance Portability and Accountability Act protects the privacy of individuals' health information. Since life insurance policies often require medical history information, agents must ensure that they follow guidelines when handling sensitive medical data. Consumer protection laws also cover areas like ensuring that clients understand the policies they purchase and that they are not being taken advantage of. For example, the free look period in life insurance allows a policyholder to review a policy after purchase and cancel it without penalty if they change their mind. Agents are required to clearly explain this feature to their clients. Finally, let's touch on the topic of fiduciary duty. As an insurance agent, you have a fiduciary responsibility to act in the best interest of your clients. This means you must offer suitable products that meet their needs and ensure they fully understand the terms of the policies you recommend. A breach of fiduciary duty can result in legal consequences and damage to your reputation. Understanding federal and state regulations is critical to your success as an insurance professional. By complying with these regulations, you not only avoid legal issues but also build trust with your clients, which is essential for long-term success. In the next chapter, we'll dive into taxation of life insurance and annuities, which will help you understand how these financial products are taxed and how they fit into your clients' broader financial plans. This concludes this part of the masterclass. Review the concepts, test your knowledge, and continue to the next lesson.